Hi, everybody. It's Peter Schiff. It is Friday, April 3rd, 2015. And in fact, it is Good Friday, so the U.S. markets, along with most of the markets around the world, were closed today in observance of the holiday. But it didn't stop the Labor Department from releasing the March non-farms payroll numbers. And it may be Good Friday, but it wasn't a Good Friday if you were expecting confirmation that the labor market is still strong. And in fact, for months now, we have been inundated with bad economic news, so much so that even the Fed's Atlanta GDP Now estimate of first quarter GDP is just zero, no growth whatsoever. But despite all of the bad economic news that has been continuing to pour in, the one exception, right, the one standout, the outlier, has been the non-farm payroll numbers, the jobs report, at least superficially. Now, most economists have been expecting the rest of the data to improve, to catch up with the jobs numbers. On the other hand, what I've been saying is I thought it would only be a matter of time for the jobs numbers to fall back down in line with everything else. And that is what has happened today, at least with the March numbers. And of course, before the numbers were released, they were already trying to pre-blame this on the weather. But no matter how you slice it, this report was terrible, and it's not because of the weather. It's possible that some jobs didn't get created because of the weather, but I'm sure it's a very small number relative to the overall report. So let's just get down to the March report. Analysts had been expecting 247,000 jobs created in March. And I guess over the last couple of days, since we got that weaker than expected ADP number on private payrolls, people were trying to lower expectations. And so there were a lot of people thinking it would come in slightly below the consensus. But very few people, if any, believed it would come in this low. In fact, the lowest estimate was 200,000. So even the people that thought it would be a bad number still thought we'd get another 200,000 print. The actual number was 126,000 jobs. That's it. That is the fewest number of jobs that we've created since December of 2013. That means we did better in the polar vortex January, February, March of 2014. This was worse than those numbers. Now, to add insult to injury, they went backwards, right? And they took, I think, 67,000 jobs away from the last 2 months, meaning they went backwards and revised the previous estimates of job gains so that those gains were actually not as robust as when they were originally reported. In fact, now if you take the last 3 months in total, the average of those 3 months is now below 200,000 jobs per month. Also, another bad detail of this report is that the labor force participation rate edged back down a tenth to 62.7, matching its record low, at least a record low in modern times. And to go back historically, it wasn't until you have to go back to 1968 or 1978 rather, 1978 to find a labor force participation rate this low. But of course, back in the 1970s, that was when women only began to enter the labor force. So far fewer women were required to work back then as would be required today. So this is a much different number. In fact, if you look at the labor force participation rate for men, I mean, it's never been this low in the history of the country. And in fact, if you also look beneath the headlines, for every one person that found a job in February, more than 2 people, more than 2 to 1, left the labor market, right? They threw in the towel. The labor force participation is going down. Now, the number of Americans who are no longer working rose to a record. 93.175 million Americans not working. 277,000 left the labor force. And another problem statistic is that among those who did get jobs in March, they were over 55. All of the job gains went to workers 55 and older. Workers who are younger than 55 actually lost jobs in March. I also looked at the type of jobs that were created. Again, about 70% of the jobs that were created were in retail, in healthcare, education, hotels, restaurants. Many of these jobs are temporary jobs, and of course, many are part-time, and most of them are low paying. So again, a very, very weak jobs report. And finally, a report that's so weak, right, that it may confirm all of the other weak economic data that people have been ignoring. Because remember, people have said, well, yes, these numbers are weak, but the jobs market is still strong, so I'm not going to worry about all this other weak data because we can still hang our hat on the strong jobs numbers. Well, there's nothing to hang your hat on anymore except to blame it on the weather. Well, the weather excuse is going to run dry soon. We're going to get spring. It is April, and it's not going to be as cold. It's not going to snow, but it may rain on the Wall Street excuse parade. That's for sure, because if we continue to get weak numbers, as I expect, throughout the spring, then this whole fantasy is going to come to an end. Now, where does this put the Fed? Now, from my perspective, it doesn't change anything, right? Because I know the Fed's not going to raise rates. I know the Fed has been bluffing since day one, right? They've been bluffing since they did QE1. But your typical Wall Street strategist, economist, who actually believes that the U.S. economy has recovered, right? He expects the Fed is going to raise rates. But the last time Janet Yellen spoke, she basically threw down the gauntlet and said that rate hikes are contingent on further improvement in the job market. Well, what has happened to the job market since Janet Yellen made that statement? The job market has deteriorated substantially, because not only have we revised lower the prior 2 months so that now fewer jobs were actually created than what Janet Yellen believed when she made that statement, but now we have the worst non-farm payroll report since December of 2013. Now, was the Fed raising rates back then? No. In fact, they were doing quantitative easing back then. Yet now we have a report as bad as it was back in late 2013. And I think it's only going to get worse. Because remember, a lot of the jobs that were created in 2014 on anticipation of a recovery that everybody had been promising, I think a lot of these jobs are going to go away. A lot of the bartenders and waiters that got hired in 2014 may get fired in 2015. And of course, a lot of these people are working part-time. And so when you have this big part-time payroll and you have to pare it back, you are firing more people than you would be firing if you were firing from a full-time workforce, because your part-time workforce is bigger. And so if you're going to cut back, you're actually going to cut back more people. See, it's going to work both ways. I think it's the big pickup in part-time hiring that helped pad the job creation numbers in the first place. And of course, people wanted to take credit for all those jobs without actually looking beneath the surface to discover the quality of those jobs. Well, it's going to work the other way as the economy begins to soften, and a lot of these employers realize they jumped the gun. They were too optimistic when it comes to the U.S. economy, and therefore they don't need as many part-time people as they hired, and so now it's going to be time to let them go. So I think that this is not a one-off fluke, and that all of a sudden we're going to have another strong jobs report for April and May, and that all the other bad economic data is going to magically improve with the improvement in the weather. If you look at all the other data about the consumer, look at the big increase in the savings rate. I mean, the savings rate is still pathetically low, but it's at a 2-year high. Also, the trade deficit that came in this week, it's about a 2-year low. We had a collapse in imports. I mean, exports went down too. So the entire economy is contracting in that we're exporting less and importing less. But imports plunged by the most in, I don't know, since the Lehman crisis of 2008. And the reason imports are plunging, I mean, part of it might have had to do with the port strike, but a lot of it had to do with the fact that Americans are just not spending as much. They're saving more money. They're not even spending the windfall that they got from cheap oil prices. They're trying to repair their balance sheets, so they're not spending, but they're tightening their belts precisely at a moment in time where everybody is counting on them to open up the purse strings and spend, with reckless abandon. But they can't do that because they're broke. They have too much debt. Their cost of living is going up. They got lousy jobs. Yet everybody expects them to run to the rescue, like the cavalry, but it's not going to happen. Remember, we had a very weak first quarter in 2014. And that was conveniently blamed on the weather, and some of it may have been weather related. I think last winter was much more disruptive to the economy than this winter. But we had that big drop, and then we had the sharp rebound in the second and third quarter. But that had to do with Obamacare spending that was kicking in for the first time. We're not going to get the benefit, if you want to call it a benefit, of that in 2015. We also had a big inventory build, particularly in the third quarter. Not going to get that again. I mean, companies are already, drowning in inventory they can't sell. So why are they going to beef it up even more? So if you're expecting a big rebound in the second and third quarter, it's going to have to come from the consumer spending more money he doesn't have. So I don't see where all this fantasy is coming from other than just sheer wishful thinking. But the Fed is going to some point have to acknowledge that the U.S. economy is not as strong as it thought. And I can already hear the calls and the justification for more stimulus, for QE4, whether they call it that or not, because everybody is going to agree the problem is that we just didn't do enough stimulus, that, it was working, right? That we got this recovery going, but it just didn't have enough power, right? It just didn't have enough oomph to achieve escape velocity. We almost broke out of orbit. The rocket ship was going up there, and it just didn't quite have enough power in the engines, and that's why it's coming back down to earth. So we have to make sure to send it up there with more power. We just need a bigger round of stimulus, right? Paul Krugman style. We just need more money printing, more inflation, more deficit spending to create the velocity that we need to escape the gravitational pull of this recession, right? So we have to go back to the QE drawing board and really, load it up. We have to do it big time, shock and awe QE. That is what is going to be called for, because nobody is going to recognize the complete failure of this program. The reason QE3 didn't work is not because it wasn't big enough, it's because it can't work, right? Because it damaged the economy. That is the problem with quantitative easing. It makes the problems you're trying to solve worse, except it makes you oblivious to that fact because you don't understand it or appreciate it until the effect of the prior round of QE wears off. Just like any drug, when you're high on the drug, you don't realize the damage that's being done. It's only when you stop taking it and it starts to leave your system that the withdrawal symptoms set in. The withdrawal symptoms, the economic withdrawal symptoms are setting in. People haven't wanted to recognize that. They've been rationalizing it. They've been excusing it because they don't understand the nature of what's going on. See, the people who think the Fed solved the problem never understood the problem from day one. That's why they don't know that everything the Fed did to solve a problem it created made that problem worse. But we're not going to acknowledge that this time, right? We're going to do another round, and this is going to be the lethal round. This is going to be the overdose on QE, because the crisis that's coming is going to be a dollar crisis. Now, the dollar was down 1% or so in a thin holiday trading session immediately following the release of this very disappointing March jobs report. But really, the decline in the dollar is only just getting started. Whether it's going to continue next week or if it's going to have to wait a little longer for people to figure this out. But you have this huge speculative bid that's been in the dollar for months based on this false notion of a legitimate U.S. recovery and a Fed that's going to be raising interest rates. We have neither. We have an illegitimate a recovery. We have a bubble masquerading as a recovery. The air is already seeping out, and the Fed hasn't even pricked it by raising rates, which is why they don't want to raise rates, because they don't want to accelerate the process. In fact, they're going to do whatever they can to delay it by blowing air back into the bubble with QE4. Meantime, I do not believe the rest of the world, particularly Europe, is going to be providing nearly as much stimulus as people think, especially when they get a load of how badly ours did not work. See, the whole justification for European QE is, hey, look how well it succeeded in America. But if we slip back into recession and have to do QE4, that's pretty strong evidence, at least to anybody who's thinking, that it didn't work. Meanwhile, the other justification for QE in Europe was that they didn't have enough inflation. Well, they're going to get more inflation, especially when the dollar plunges, and I think that sends up commodity prices. And so that is going to maybe reverse some of these pressures that have caused European politicians and central bankers to panic and lower rates much more than they should have, because they somehow feel that this decline in consumer prices represents some kind of threat to prosperity. Well, you know, they're going to be thankful, I guess, when the prices reverse and all of a sudden they have more inflation than they bargained for. And so ultimately they're going to cut these stimulus efforts short. But this is going to catch the currency traders by surprise, as they quickly have to reverse their wrong speculative bets on the dollar. But because the dollar rallied so much on anticipation of this, it's got a ways to fall before it gets into crisis mode. I don't know how long that's going to take, but eventually that is where we're going. You know, when people keep asking me, when is the Fed going to raise rates? They're not going to do it because the economy is strengthening. They're going to be doing it because it's weakening, and because the currency is collapsing, and because they have no choice but to try to raise rates, but to stop the bottom from falling out of the dollar. And that is not the decision that the Fed is going to be happy about having to make. And it's not the type of rate hike that people expect, because everybody says, well, it's okay if the Fed raises rates because they're only going to do it if the economy is strong. Well, if they do it, the economy won't be strong. That's the point. And when they actually get around to raising rates, it's going to be when the economy is very weak. And you know what? It's going to get even weaker, because in order to cure the problems, it's going to take some short-term pain. It's going to have to get worse before it gets better. And of course, getting worse is merely superficially, statistically, because all of those things, right? Consumers spending less, consumers saving more, right? Us allowing asset prices to decline to where they should be, right? Restructuring of the economy, defaults on debt. All of this is progress. All of this is a positive. It's a step in the right direction. It may not feel right, but it's going to work. The problem is we have been resisting the cure while the disease gets worse, and more people just believe, because we've been able to somehow cover up the symptoms or deny that they exist, that we think the Fed has actually cured us, when in fact they've made us sicker than ever.